Is your bank actually reporting you to the government? Here's the truth behind cash reporting rules, without the drama. If you've heard that depositing a lot of cash can get your account flagged, that's partly true, but the reality is a lot simpler and a lot less scary than it's often made out to be. Here's what US law actually says. This is a real law, and it's been around for over 50 years. Back in 1970, Congress passed something called the Bank Secrecy Act. It gave the Treasury Department the authority to require banks to keep records and file reports to help detect and prevent money laundering. This isn't some hidden rule. It's published openly on the government's own website. The part everyone's heard about is the $10,000 threshold. It is really just routine paperwork, not a criminal flag. Under this law, every bank has to file a report anytime someone makes a cash transaction over $10,000. If you make several smaller cash deposits in the same day that add up to more than that, and the bank realizes they all belong to the same person, those get combined too. But here's the key thing to understand. This is an automatic statistical report. It is not an investigation. Most of the process is fully automated these days. The teller just needs your social security number, a valid ID, and sometimes a quick note on where the money came from, and the bank's software handles the rest. You typically won't even see the form being filled out. One detail that gets left out a lot. This rule is about physical cash. Personal checks or wire transfers over $10,000 generally don't trigger this kind of report because they already leave a digital trail. So things like social security payments, pension payments, or a tax refund landing in your account by direct deposit don't set this off at all. There is a bill in Congress right now that would raise that $10,000 threshold up to $30,000 and adjust it for inflation going forward. As of early 2026, that's still just a proposal. It has not become law. There's also a second kind of report people talk about called a suspicious activity report. A lot of alarmist content claims this one has no dollar threshold at all, just to make it sound scarier. That's not quite accurate. Banks file this kind of report when they notice a transaction that looks suspicious in some way. Under current proposals in Congress, the relevant dollar threshold for this is being discussed as moving from $5,000 to $10,000. So there is a threshold today, it's just less well known. This type of report is really meant to catch unusual patterns of behavior over time, not the size of any single deposit. The IRS does compare data from banks, employers, and investment accounts against what you report on your tax return. That's true, but this isn't some secret new policy that started in 2026. It's the same kind of routine data matching that's existed for a long time, and it's just gotten faster because more of our financial lives are digital now. That's a broad trend across the whole system, not something aimed specifically at older people. And here's something really important. A large legitimate deposit, like money from selling a car, an inheritance, or closing out a property sale, is not taxable income in most cases, and you don't need to report it as income. If you ever do get a letter from the IRS asking about a deposit, that is usually just an administrative request for some documentation. It doesn't mean your account is frozen or that anyone is coming to seize your assets. So what's actually worth doing? Keep your paperwork. A bill of sale, inheritance documents, closing statements, anything that shows where a large deposit came from. That's the single best way to protect yourself if a question ever comes up later. Don't try to break your deposits up into smaller amounts to avoid the threshold. That's actually the one thing that can get you into real legal trouble. It's called structuring, and ironically, trying to dodge the report is far riskier than just making the deposit normally. If you get a letter from the IRS or your bank, read it carefully, but don't panic. Most of these are routine and come with a clear deadline to respond. And if something genuinely unusual happens with your account, talk to a real licensed professional, a tax attorney, a CPA, or an enrolled agent, rather than taking advice from a scary video online. Finally, it's worth being skeptical anytime content uses fear to sell you something. A lot of these videos and articles take completely normal banking rules and describe them in the most dramatic way possible. Then, somewhere near the end, they try to sell you gold, an annuity, or some kind of asset protection service. The underlying laws are real. The scary framing is usually there to sell you something, not to actually inform you. This is educational information only, and it isn't a substitute for personalized legal or financial advice. If you're dealing with a specific situation, it's worth talking to a licensed attorney or tax professional. Fairness Act corrections that began in 2024 and continued through 2025 and 2026. Each of these events is completely ordinary in the context of a retired life. Each of them looks to an automated monitoring system built to detect criminal activity, like exactly the kind of irregular large deposit it was designed to flag. And for many retirees, the instinct when these events arrive is to handle them carefully, to deposit them gradually to avoid drawing attention, which is precisely the instinct that makes the situation worse. Now, I'm going to give you the 5 things that protect you, and I want you to understand these not as rules to follow out of fear, but as a clear picture of the one thing that separates a clean transaction from a complicated one. The separator is transparency. Every single protection comes down to making your legitimate money visible, documented, and deposited in a way that tells its own story clearly. The first protection is the most important and has no exceptions. If you have legitimate money to deposit, deposit it in full in a single transaction, not in pieces spread across weeks, not in amounts calibrated to stay below a threshold, the full amount once on the record. The currency transaction report that gets filed when you deposit $15,000, $20,000, or $40,000 is not a problem. It is routine paperwork that banks file on millions of legitimate transactions every year. For an honest person with documented legitimate money, that report disappears into a database and nothing follows. The structuring pattern, the repeated below-threshold deposits, is what the system is built to catch. Depositing your money in full is not the risky option. Breaking it up to avoid the report is the only thing that is actually dangerous. The second protection is documentation. For every large deposit, have the paper that explains where the money came from before you walk into the bank, a bill of sale if you sold a vehicle or property, an estate settlement letter if you received inheritance funds, a gift letter if a family member provided the funds, an award letter or statement if the deposit is a pension disbursement, a retroactive Social Security payment, or a required minimum distribution. You do not have to submit this documentation unsolicited. You hand it to the teller, you ask them to note the source of funds on the transaction record, and you keep a copy. That one step transforms a large deposit from a pattern that needs to be explained into a transaction that already explains itself. The third protection is advance notice. If you know in advance that you are going to be making a series of large deposits from a single source over a defined period, call your bank before the first deposit and explain what is happening. Tell them you are receiving estate proceeds and will be depositing them over the next several weeks as the estate closes. Tell them you are consolidating savings from a prior account and will be making several large transfers. Ask them to note your account file. This 5-minute conversation creates a record before the monitoring system has any reason to flag anything. It does not guarantee protection, but it provides context that an automated system operating in silence never has. The fourth protection involves your tax return, and this is the piece that the 2026 electronic payment integration makes more critical than it has ever been. The IRS Automated Underreporter program is looking for gaps between what your bank reports to the federal government and what your tax return shows as your income. If your checking account receives a large deposit from income you earned, make sure that income is reported. If the deposit is not income, if it is an inheritance, a loan repayment, or the return of your own money from another account, make sure you have documentation that clearly establishes why it is not taxable. The protection is not complicated. It is making sure that what your bank account shows and what your tax return shows tell the same consistent, honest story. When those two stories match, there is nothing for the cross-referencing system to flag. And the fifth protection is a 5-minute task that most seniors have never done, and that costs nothing. Go to irs.gov and log into your IRS online account. Pull up your most recent tax transcript. Look for any notices, any proposed adjustments, or any balance due amounts that you were not expecting. If something is there that you do not understand, that is the moment to contact a qualified tax professional, not after a notice has escalated to a collection action. The automated underreporter system does not always send a physical letter before it advances. Checking your online transcript is the only way to see what the IRS sees about your financial profile, before a discrepancy becomes something you have to respond to under deadline and under stress. I want to close with the honest context for everything I have covered today because I think the most useful thing I can offer is not fear, but understanding. The Bank Secrecy Act was written in 1970 to catch money launderers, drug traffickers, and organized criminals. The people who wrote it were not thinking about retired electricians in Ohio depositing their late mother-in-law's estate proceeds. But the mechanism they created, an automated pattern detection system with no ability to read intent or apply context, catches both groups equally. And the Civil Asset Forfeiture Authority that allows funds to be seized before any criminal charge is filed, with the burden on the account holder to prove their money is innocent, has been documented in Inspector General reports, in congressional testimony, and in published legal advocacy records to have caused real harm to real people who had done nothing wrong. The 2015 and 2019 reforms that restricted the IRS from pursuing legally sourced funds in most structuring cases were important steps, but they did not end the authority. Structuring is still a federal crime. The Department of Justice retains enforcement authority, and the Suspicious Activity Report System, which has no dollar threshold and which banks are prohibited from disclosing, continues to generate federal reports on innocent account holders whose only mistake was following advice that felt protective but turned out to be the exact behavior the law was designed to punish. The seniors who are most at risk are not the ones with complicated finances, they are the careful ones, the ones who heard once that large deposits attract attention and tried to be responsible about it, the ones who were managing their money thoughtfully and had no idea that their thoughtfulness had a legal name that carried a 5-year federal prison sentence attached to it. Now you know what that name is. You know what the system is watching for. You know what the 5 protections are. And you know that the safest, cleanest, most legally sound thing you can do with your own legitimate money is also the simplest. Deposit it in full. Document where it came from. Make sure your tax return reflects your actual financial activity. Check your IRS transcript once a year. And call your bank before any unusual pattern begins so that the context exists before the algorithm ever has a reason to look. That is the complete protection. It costs nothing but the time you spent watching this video. And the seniors who know it are the ones who never have to discover what the system does to the people it catches.